Good morning and good early afternoon, ladies and gentlemen, and welcome back to another Real Estate America's Newsroom. It is currently the 16th of June in the year of our Lord 2022. Action-packed show as always. Buckle up. The Fed, the great Federal Reserve, just went ahead and hiked 3/4 of an interest rate yesterday to go ahead and curb inflation. We're going to go ahead and talk about that and what it means for you. Real estate companies Redfin, Compass, amongst many others in the tech industry, are starting to contract and lay off their workforce. What does this mean? We're going to tap into a little bit of a speech with Mr. Jerome Powell from the Fed on his take on the housing market. And we're going to spin that at the round table with all of the fellas. Obviously, we're going to have to get into mortgage news with Captain Kirk Jaffe. Today of days is where you want to stick around for Captain Kirk's mortgage news report. And our housing predictions, ladies and gentlemen, for the rest of the year in 2022, our housing predictions. So I think there's going to be some different opinions on the board at the end of the show. Weigh in on the comment section to go ahead and see what's going on there. But before we get moving forward, as always, I'm going to introduce my esteemed, illustrious, and wonderful co-host, Mr. Nick Sakis. How are you doing today, sir?
Esteemed, illustrious, and wonderful. I'll take all three.
Oh, you're a little quiet on the mic. It's like super quiet.
Here we go.
Oh, there we go.
That better?
Yeah, coming in hot. Now we're good.
Okay.
Yeah.
I said I'll take all three of those compliments, my friend. Thank you very much.
Yeah, I figured I would stack you up with a wonderful alias.
Yeah, we got a heavy
You're
show.
a wonderful guy, Nick Sakis. People should know who you are.
Thank you. I do have some news that's not pertaining to our crazy market right now, but the Tampa Bay Lightning did lose the first game of the Stanley Cup last night, so I'm a little bit sad.
Wait a second. You said you had lightning in Tampa last night?
Yeah, they were playing Colorado, or as my 5-year-old calls them, the avocado avalanche, because he has a hard time saying Colorado. So we watched the game last night, but we were disappointed, unfortunately. So we got to come back and.
Truth is what rolls over the lips of children, and if your boy wants to call them the avocados, I'm all in.
Yeah, we were trying to make some guacamole last night, smashing some avocados.
We've got a lot to talk about today, Mr. Nick. The Fed is working hard to go ahead and curb inflation and to go ahead and stabilize our environment and our economy and all other things. United States, what say you on this?
Can it get any worse?
Well, I heard in 4 weeks they're meeting again to do it again.
Yeah, I mean, if I'm on the fence right now as a buyer, I am super nervous about what's going on. Right? If I'm a mortgage broker and I quoted people last week on trying to lock in a rate, and this week I have to call them up and say, "Hey, sorry, your rate is now 0.75 or 1% more than it was 2 weeks ago." That is not a good conversation.
Yeah. Ladies and gentlemen, stick around. We're going to arm you with some very powerful knowledge nuggets from the Real Estate America's Newsroom with all of our professionals. Maybe you can take away some of the talking points today and go back into your marketplace and get to work, because obviously we're busy right now. We're very busy. Ladies and gentlemen, we're streaming live on the REU Nation Network. If you haven't gone to reunation.com yet, you should check it out. Over there, we've got these really cool, awesome news pages for Real Estate America's Newsroom. So you can check out all of our latest episodes. You can see where we went right and wrong with our opinions. You can also enter your information to get all of the insider news show notes. So we send out the show notes to everybody. So make sure you enter your name, phone, email. We won't overly bother you. We'll just keep you informed, right? And if you guys want to go ahead and be on the news, or have some hot insider information in your local marketplaces that we should be sharing with all the folks in the great United States of America, please enter this information here. Leave us a message. We get back in touch with you. Nick, when do we actually do this show, and why should people watch us?
Every Tuesday and Thursday at high noon, as Sarge likes to say.
Yeah,
this show is to keep you guys informed. We spend a lot of time, effort, and energy. And the main reason, again, it's not like you guys can't watch the news. But watching the news and then conveying it into what's going on in individual markets is what we're after. So we have guest panelists from all across the country to give their opinion, boots on the ground, what's going on in their market, in order to equip you as a professional real estate agent / broker in your market with the most up-to-date information that you can possibly have, so that when you are going to market and talking to your customers with your scripts and objections and everything you need to be successful, you know exactly what's going on.
Absolutely. And ladies and gentlemen, if you guys are watching live, you can throw your comments up. A lot of times we bring your comments right into the show, and all of our wonderful co-hosts go ahead and comment on it, answer questions. Also, we ask that if you like us, smash the like button, hit the bell. If you don't like us, there's the other side of that too. So,
Yeah.
but interact and share some love, and we'll go forward and keep making sure we're spinning the news behind the scenes here. So, Nick, let's get right into it. What say you?
Let's go.
All right, cool. So, ladies and gentlemen, as I'm sure you're all aware, the Fed went ahead and made a substantial increase in their interest rate, right? So let's talk about it. Here we go.
We are your station for money, and to help curb inflation, the Federal Reserve has raised interest rates for the third time this year, and this time 0.75%, which is the biggest increase since 1994.
And tonight, our consumer reporter Heather Sullivan is joining us live in studio with some smart sense on what this all means for your wallet.
Yeah, so the Fed's move means that credit cards, mortgages, and auto loan rates are all about to go up for the third time this year. So here's a look at how much more you'll be paying.
At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, resulting in a 1.5 percentage point increase in the target range so far this year.
If you're looking to buy a home, the average interest rate on a 30-year fixed rate mortgage has jumped from 3.11% at the end of last year to 6.28% this week. According to Grove's Mortgage Calculator, a $300,000 loan that cost you $1,283 a month in January will now cost an additional $570 every month.
This shelter cost issue is really turning out to be a crisis for many Americans who are trapped by high rent and yet don't have the means to buy a home.
Creditcards.com says average variable credit card rates are 16.61% right now, but could hit a record near 19% by the end of the year. So if you have the average credit card balance of $5,525, and if your rate climbs to 18.61% and you make only the minimum payments, it'll cost you an additional $832 to pay it off. Buying a car, auto loan rates don't climb as quickly, but new car prices are up 13% over last year, and used car prices are up 16%. The biggest problem is for buyers taking longer loans of 5, 6, 7 years to bring down their payments.
The problem is that with a new car, the minute you drive that car off the lot, as we like to say with personal finances, you are underwater because the amount that you owe on that car is more than what the car is valued at. It's one reason why I tend to favor generally buying used cars during times of low inflation.
So here's some smart sense to help you through this time. Pay down as much credit card debt as you can before rates go up. And you want to shop around for mortgage and auto loan rates. Make sure you get the lowest rate that you can qualify for. Heather Sullivan, Fox 26 News.
Things are happening in the mainstream media news. Let's go ahead and bring in some of our professionals behind the scenes here. Mr. Kirk, what's going on with the Fed? What are they doing? Break it down for everybody really quick. Why are they doing this?
Yeah, well, they're raising rates to get inflation under control. So that, they have two tools. The Fed can raise short-term interest rates, which is what we're seeing now when the federal funds rate increases. And the other thing they can do is run off their balance sheet or increase their balance sheet, which is what buying mortgage-backed securities and other investments do. Right now, the Fed has just started in June to run off about $90 billion of their investments. They own about $9 trillion. So they're looking to reduce it by about, 10%, 15% over the next year. And that should get inflation under control. And I think we actually do see, even though we're in the midst of it right now, if you look at the charts, things are starting to slow down. It doesn't mean they've got it under control yet, but I think by the end of the year, we'll be there.
Outstanding. Mr. Tim, what's your take on all of this?
Yeah, no, I think the Fed, like Kirk said, they've got very few tools to actually control inflation, control the markets, keep it from running away from them. And they're turning those screws. If they turn them as quickly and as tightly as they wanted to, we would all freak out. And so I guarantee you, they wish they could turn them quicker and tighter, but they understand that would be a backlash. So they're doing it as quickly as they think that they can do it without causing alarm. And yet it's still going to cause, it's going to cause some pain and some discomfort for people as they move forward. I just like to keep an eye on it and see what happens. But again, this is just what the Fed is controlling, and this is for the markets. But there's just a lot of different factors going on that may well be outside of their control. So we'll see.
Nick, what is your take on all these things?
I don't know if I agree with some pain and discomfort, Tim. I think there's a little bit more than that. Everybody's pain threshold is a little bit different, right? I break my arm, I don't cry, but you break your arm, you might cry for a couple days, right? So there's a couple different things. Not you personally, Tim, you know what I'm saying. But I think it's really right now. So I was on TikTok yesterday, and there was a video that went viral with a mom, a single mom. She was like, I think 35 or whatever, and she literally did like a 3-minute video talking about, how am I supposed to survive right now? How am I supposed to survive as a single mom with 3 kids and a single source of income when my grocery bill's gone up 25, 30%? My kids' aftercare is going up. My gas is going up. I can't even afford to fill up my Tahoe. So I sold my Tahoe and bought a cheap Honda Civic to get around, and my kids are crammed in the back. Like, how long is this going to go on? And I think the problem is this is just the beginning, right? So it's really, really, really scary right now. I just posted pre-show. I was talking to the guys, pre-show, a house in my neighborhood that just went pending for $775, which is literally $200,000 more than anything that sold in my neighborhood in the past 12 months. And somebody bought it in 10 days on the market. And maybe he's happy about it. Maybe they got their interest rate locked in lower from last week than it is today. It's just, we don't know what is happening right now, to be honest with you. And it's definitely scary.
So I have a question for everybody, and even in the audience. We're being told inflation rate is in the 8%. Okay, so this is based on a CPI factor that they've done some scientific manipulations over time. Back in the old school days, we're talking the 70s and 80s, the CPI index was factored into some core inflationary verticals. Now, here's what I mean by this. If we're looking at the mainstream media and it's saying, oh, we got 8% inflation, I would venture to say the majority of households in the United States of America, the majority of their money go to what? Food, gas,
power bill, electricity,
electricity. The majority of the folks that are borrowers and workers and everything else like that make up 80% of what our outflow financially is going on. So in those core verticals, what truly is the inflation rate? Am I only paying 8% more at the gas pumps? Nope, I'm not. Am I paying only 8% more for food? Nope, even though my steak is still juicy and I like it just on the pink side. And Mr. Tim introduced me to sous videing my steaks, which is awesome. I highly urge everybody to do that. Sous vide. Is that what it's called? Sous vide?
Hot meat bath. That's what it is.
He's got that deep V like Salt Bay. He's probably sprinkled some salt at the end too.
There it is.
I'll tell you what, ladies and gentlemen, when you get into the sous vide or vide or whatever it is, I mean, there's
not
some
bidet. It's not a bidet.
When you dunk your meat in a hot tub.
A meat hot tub. I like meat hot tub.
Yeah. However, it's costing me more to go ahead and heat up my meat hot tub because my electricity is more and that meat is more and everything else. These are all core inflationary issues in my household, right? So hell, even in the pool, I can't filter the pool as much as I want to anymore. I'm backing that off about 3 or 4 hours, and I can't heat up my jacuzzi like I used to anymore. These are all major issues and concerns. Anyways, just joking aside slightly.
That's the major issue.
Yeah, slightly joking around. But anyways, the majority of American households have these big core pillars of inflationary issues, and this is what we spend most of our money on. So it's not 8%. Most of us are paying double. And on Tuesday's show, Mr. Kirk was talking about the average household savings in the United States of America pre-pandemic was in the mid 30 percentiles, and now we're seeing statistics below 10%. People are starting to consume their savings and contract. There's a lot of contraction that's happening. Now we're seeing major employers start laying off folks. So Paul, break it down for us. You've got some good friends in the restaurant industry. Have you seen a change in your local marketplace in the restaurant industry? Because that's usually the first thing that people go ahead and back off on.
Absolutely. We're seeing it in our restaurant, and all my friends are seeing it in their restaurants. Restaurants are going up for sale for two reasons. One, they cannot find help to do the work. And two, the cost increase to keep it going. We're passing it on to a smart person was pass it on to the customer. That's the only way you're going to make it, because you cannot produce. Restaurants are in a really hard time right now, regardless. And it's going to get that way. The bigger they are, the harder it's going to get in the future. You need to have a strategy to stay in business, something different than everyone else. I think it's a great entrepreneurship, but I also think that it opens doors to corporations to come in. We were just talking yesterday about how they want to bring robots for servers. I don't know if you guys seen that.
Yeah, we did saw like a McDonald's clip. There's some new technology to go ahead and actually install robot arms and stuff to go ahead and flip patties and dunk French fries.
I got served food at a bowling alley by a robot a couple months ago.
Yeah, we got a sushi joint that has a robot brings it to you.
So. You see, and they're working on robots to do the cooking now. I don't know what's going to happen. I really don't.
Because food isn't really cooked anymore; it's just warmed up.
A lot of it.
Jeez.
A lot of it's pre-cooked in companies, and they're pre-packaged, and they're set at a rate to where the consumer can buy it, and the average restaurant person, most people are not chefs, so the average person is going to buy it and resell it for a profit. When I really think, just like in this business, if you're going to go in the restaurant business, you need to study food, and you need to make something that's going to separate you different. You know, a lot of people love food trucks. Why? Because it has to be made right there. And people appreciate that, and they'll pay a few extra dollars. Well, that's the same thing in this business. If you're a real estate agent in this business, you need to find out what you can do to separate yourself to continue to produce as an agent. And I'm sure in the loan business as well, Kirk. But, people are still getting married. People are, God rest their soul, people are still dying. People are still having children. They still need to downsize. Separate yourself different from that agent, from the average agent, so you can produce better and provide value to your customer and your client. And that's what I'm saying. Talking about this, for $100,000 loan, they just went up 0.75%. So that's $750 a year. Is that right, Kirk?
It doesn't exactly equate. So when the federal funds, if you want to show that chart, Jake, I can explain it. But here's the chart. So the top line with the white boxes is the short-term interest rate. We had a 75 basis point hike in the short-term federal funds rate. That's that white box at the top. You can use that as a reference. The blue box at the bottom is the runoff. That's where the Fed stops buying mortgage-backed securities and other investments. So they're pulling money out of the market. The line down the middle is what the mortgage interest rates would be. So you can see they started hiking rates. This is back in 2018, this chart, but it's the same story today. They've been hiking rates slowly. We just got a big 75 basis point hike, and they just started running off that balance sheet in that first blue box. So we're just really in maybe the first or second inning of this game of them getting inflation under control. But you can see what happens. The more they hike rates and the more they run off their balance sheet, mortgage rates actually start going down. So when we see a 75% basis point increase, you did see, ironically, it's not even ironic, just coincidentally, mortgage rates went from 5.2 or 5.5 to about 6%, 6.2 in the past 5 days. That's as much a function of banks taking profits up front. If you remember on the last show, I said expect interest rates to hit 7%. So if we're trying to manage a consumer's expectation, tell them the rate's going to be 7%. And then when you get it down to 6.5 or 6.25 or whatever we can get it at, their affordability improves, and they're going to feel better about it. So, and we'll get into it more in the show, but it's not a one-to-one ratio. It's important to remember that.
Ladies and gentlemen that are watching us right now, I'm curious if you can add in the comments, maybe you guys have some stories about some of these inflationary and economic pressures that are happening in your neck of the woods, or to somebody that you know. Give us some examples of maybe some pain points that you're seeing in your local marketplaces. We'd love to pull it up on the screen. So Tim, quick question for you. the Fed's job is to go ahead and get the interest rates out above the inflation rate to go ahead and stop or stagnate that inflationary increase, right? So, but if our factors are wrong, if some of our core inflationary issues are not being calculated properly, shouldn't we have to go ahead and get up higher than what's going on right now? And then if we do, how can people even afford it right now?
So I think the really interesting thing right now is the Federal Reserve, which is not federal and has no reserves, is going to be a bit in the fishbowl as people start looking for who's responsible. And, you know, in our last, major crash, which was, a lending issue or whatever, people could go, okay, well, that's what happened. This is who caused that. And, they can, have the bad guy, right? But they also didn't feel it coming quite like we feel this one coming. Like everybody's, neck hairs are on end. People are feeling it. They know something's wrong. They're looking for who is responsible, who can fix it. And I'm telling you right now, the Fed is in a stinking fishbowl right now. And whether everybody's looking at them or not, people will start looking at them. And what happens moving forward, whether or not they're able to right this ship or not, I don't believe they will. That's just my opinion. People will see just how inefficient and, inadequate they are at actually handling what we've got going on. And they're ignoring the right numbers and basing it on the wrong numbers, or it's on purpose. Right. I don't know. So that, to try and, to me, it's like asking me to empathize with crazy. I can't empathize with crazy. I have no idea what that's like. I can't justify the behavior. Apparently there's a clip of some guy with a big stick whacking cars in the middle of the road. Like, I have no idea why this guy is beating up cars with a big stick. Right. But it's happening and people are going to see it. Right. So I feel like that's kind of where we're at metaphorically.
Kirk, break it down for us.
Yeah. You're right, Tim. It feels terrible right now. People don't understand. They don't have the historical. Look at all these millennials. I do a lot of business with millennials, and I love all people, including millennials, right? But they've been on a buying real estate buying spree for a couple of years now, buying Airbnbs and things like that, and they think that their income's going to continue to go up forever. And my biggest warning to anyone that's new in real estate investing is, make sure you understand where your cash flows are coming from, and that you can carry a property through a bad time. Because we're about to hit a bad time. When inflation goes up, people stop taking vacations. Vacations slow down, rentals are going to go down, right? Mm-hmm. This here is just a quick indicator of what happens to mortgage rates during recessions. That thick blue vertical bar is a recession period. And we are definitely coming into a recession here, which I could go through the numbers. But you can see during recessions, mortgage rates typically drop. So we're going to have some pain. And we're going to see it on some other things we talk about today, where other officials are actually also predicting lower interest rates coming in the future. But they got to get inflation under control and ease this pain that we're all starting to feel and that we're going to feel for a little while here.
Interesting.
I got a question for Kirk. I know the interest rates are going up for the housing market to help control the inflation. How about for all the other businesses who want to get a loan? Do you see rates going up for them as well?
So that's a great question. So that what you said about the federal funds rate earlier, Paul, federal funds rate impacts short-term and commercial loans. So anyone that wants to get a business loan is going to pay more based on that federal funds rate. Business loans just went up 0.75%. Credit card payments, credit card interest rates are going to go up almost probably 0.75%, because that federal funds rate impacts short-term loans and business consumer loans and car loans. So I expect all those rates will go up. Mortgages are a little bit different. They're not directly correlated to the federal funds rate. So we actually see things move in reverse in the mortgage market compared to what you see in the consumer and commercial lending markets.
I see. Thank you.
So for all of the folks that are subsidizing their lack of income with credit cards, it's just going to
big problem. You want to reduce your credit card debt right now, reduce your overhead as much as you can, and really take a hard look at those household budgets. And unfortunately, restaurants and things like that are going to take a hit for sure. Yeah. But I think it's also a time where people have to start looking at retraining their abilities. You know, in America, we haven't done a great job over the last 50 years, say, of retraining people. So we were talking earlier about robots taking over serving positions. Okay, those servers are going to have to elevate their abilities and get into different positions. You know, technology, coding, wherever the next future of jobs are. And I think that's on the technology side going forward.
So big corporations, gentlemen and ladies and gentlemen that are watching, are starting to take a look at this thing and contract. So let's move into the next segment. In the real estate space, some big names: Compass, Redfin laying off folks. Netflix is also. Facebook hiring freeze. Tesla hiring freeze. Coinbase dropping. All this last week. So what's going on? They're getting ahead of it. Let's go ahead and take a look at what the mainstream has to say.
Well, and yet another indication of the declining economy, the real estate market continues to cool off. Mortgage rates are climbing, and in recent months, home sales have declined in a number of times. Now, let's talk about the latest news now with Emily McCormick. Emily, we're learning of some big-time layoffs in the real estate industry. What are you learning?
Well, Dave, the slowdown in housing market activity you were just alluding to is now leading to layoffs at some major real estate companies. The real estate brokerage Compass said in a filing today that it plans to lay off about 10% of its workforce, or about 450 positions. Now, this is part of a set of strategic actions that Compass expects will help streamline costs. But in the near term, Compass does expect that this will contribute to pre-tax costs of between $21.5 and $23 million in the current quarter. Now,
All right, so that's the Compass side. And here at CNBC, this gets into a little bit more Redfin, because we've been listening to some of the Redfin top executives contribute to the mainstream media over the last quarter. So let's see what they did.
Welcome back. We've got a news alert, actually several news alerts today on housing. Let's get right to Diana Olick in Washington. Diana?
Well, Kelly, real estate giants Compass and Redfin both just announced layoffs as the formerly red-hot housing market makes a sharp U-turn and mortgage rates just keep moving higher. Take a look. The average rate on the 30-year fixed jumping 10 more basis points today to 6.28%. A week ago, it was 5.5%. That's from Mortgage News Daily. Rising rates have caused home sales to drop for 6 straight months. That's why the layoffs. Redfin cutting 8%. CEO Glenn Kelman posted in a blog today, we could be facing years, not months, of fewer home sales, and Redfin still plans to thrive. If falling from $97 per share to $8 doesn't put a company through heck, I don't know what does. Compass also in an 8K filing announced it will lay off 10% of its corporate staff. A spokesperson there saying, due to the clear signals of slowing economic growth, we've taken a number of measures to safeguard our business and reduce costs, including pausing expansion efforts and the difficult decision to reduce the size of our employee team by approximately 10%. And that equals about 450 employees. Kelly, not surprising in these layoffs, but just continues to get worse.
It feels like it's spreading. You know, we started talking in crypto about the froth there, and now the layoffs, and now we're starting to see it. Wouldn't you say this is the beginning, Diana, of what unfortunately could be more to come in housing?
Absolutely. I mean, you look at this from the real estate agencies. We know that the bleeding in the mortgage market is just getting worse with demand, volume for applications down 50% from a year ago. You expect to see more pain both in the mortgage market and in the housing market for agents. And the question is, how much does that go into commercial real estate, et cetera? We will just keep watching.
And that mortgage rate popped again, didn't it? We're almost up at 6.3% now.
Yeah, 6.28%. And it's shocking because a week ago we were at 5.5%. Wow. And that's just an amazing jump for 1 week. Obviously, since the beginning of the year, we started this year at 3.29% on the 30-year fix. So it's just astounding how quickly we've seen mortgage rates rise before in the past, of course, just not this quickly.
Exactly. It's the speed and the magnitude, not just the level. Diana, thanks for now. We appreciate it. Diana Olick.
Shepard Smith here. Thanks for watching CNBC on YouTube.
You're welcome, Shepard. You're welcome. That was Shepard Smith. He was thanking us. All right. So, Nick, break it down for us. What's going on? Big companies are contracting. I heard Redfin was trading at $97 a share not so long ago. Now it's below 10.
We talk about the pandemic accelerating a lot of things, like Zoom meetings and just technology in general, what people expect, how to do business. The other thing the pandemic really accelerated is companies who are terrified to understand or realize how lean they can get, and having people work from home. So it's like, be careful what you wish for. You started working from home, and then companies go, oh, we realize we don't need 50% of you guys because you're at home lollygagging, and we did just fine. In fact, we even did better than we did the year before. So why not lay off half the workers or 20% or whatever? So we're in this space right now. It's not just the real estate space, right? It's all over the place. All these companies that had all these remote workers are realizing they can be a lot leaner than they were, and especially when their stock market has tanked, their prices tanked. It's the only solution for them.
Interesting. Tim, they're laying off. Businesses are contracting. Whenever there is tough economic times or pressures like this, everybody's starting to tighten up their belt, and these are first signs, big major signs. Large companies, large corporations. What say you?
Well, I say businesses are not in the charitable business, right? They're in the business of making money and keeping money, and if it's costing them more money to stay open with a certain level of staff, then they've got to tighten the belt. And so that is what you sign up for when you when you have a job, right? A job. And so yeah, we're seeing people go through the effects of, being at the mercy of a company who isn't, making their ends meet the way they'd like to. So hey, we got to make some cuts. For them, it's business. It's not personal, but it feels personal and it's painful. And there's a whole lot more to come. And that's unfortunate, but there's a lot more to come.
I think the mindset, if you could shift your mindset right now, especially, like, don't expect anybody to take care of you, right? You need to be on the offense as much as possible right now. We talked about this before about, being nimble in the job market. You might have been at your company for 10 years. Like, that means nothing, right? Take a look at the job market. Take a look at your skills and abilities. If you need to craft some new skills and abilities to do something else, now is the time to be up at 2:00 in the morning while your kids are asleep, figuring out what you're going to do, because to think that your company is just going to take care of you or this won't happen to me, you can't have that mindset.
Yeah, it was funny. Somebody made a comment on responding to me. They don't want to see their Chili's server doing coding. They were scared, but it's exactly that, Nick. We're in a space right now where a lot of people that serve and work in restaurants are younger people. It's their first job, generally speaking, or it could be their last job, right? If they're just finding a way to bridge a gap at the end of their career. But it's a great time, Nick, to your point, to learn a new skill and take this as an opportunity. If we all just watch the media and run around being scared all the time, it's going to be worse, and it'll take a lot longer to get out of it.
There was a huge thread on Reddit of all these DoorDash workers like a couple months ago, talking about how are they supposed to make a living, with gas prices going up and everything, and like the whole consensus of the whole thing is nobody told you you're going to make six figures delivering food, right? Like, you went into this thing thinking it was something else, and it's not, and now we're shrinking and times are different, and your skill, and not to knock anybody's door dashing, like, that's cool, just know it is what it is. It's a low skill type of work, right? Those types of positions are going to get disseminated.
Well, think about the consumer of that DoorDash, right? So if all of a sudden they start having financial constraints, they're going to be less
luxury.
Yeah, it's a luxury.
100% luxury.
Yeah, without a doubt.
I never understood that to this day. I made a joke on my Facebook about it. Like, I can't wait to have enough money in my bank account to be able to get fast food delivered and not care. Like that, the idea of getting delivery of fast food is mind-boggling to me. And I'm a millennial, so I don't get it.
Well, speaking about millennials, I heard that over 70% of millennials over the last year have actually cried during their real estate transaction.
Tears of joy?
Where does that come from?
No, I don't know. We'll have to bring it in on the next show, but there's literally mainstream reports that are talking about straight tears during their transaction. So, Paul, what's your breakdown on this as far as companies contracting and this latest report?
So I was talking to a real estate agent not too long ago, and we're talking about brick and mortar and how the real estate firms are changing. And he strongly believes eventually everything's going to be electronical firms. I don't know if I believe that 100%, but he used Uber as an example. How many yellow taxi cabs do you see out there today? Not counting New York.
Right.
Okay. It's still people doing taxi services. It's just changed. And Uber's another one of those. The thing about Uber, though, DoorDash. The thing about DoorDash is it's a delivery service, and not everyone had it. But at one point, people were delivering. Domino's was delivering. They just took the delivery service to another level. I'm really shocked that Redfin and Compass laid off people. I'm with Keller Williams, so we'll see what happens. But I don't know. I know there's changing the way we do things. I think the service will still be there. So if that makes any sense, I'm not sure. I like what Nick said about getting your skills up. Let's think about it. For the majority of people, when they got their checks from the government during COVID, your COVID checks, what do you think the majority of people did with those checks?
They went and bought a new flat screen television.
Exactly.
Or they spent it on DoorDash.
Yes. They went out and they ate. We sold more snow crab legs and ribeye steaks when those checks were going out. And there was more TVs sold and more vacations taken. Who invested it into something that's going to be income producing?
So listen, you want to be recession proof? Learn sales. Like by far. If you are not an egghead and you don't care, you don't know how to turn on a computer, or maybe you're halfway tech savvy, like forget. Everybody's going into the gold rush of tech. Everybody wants a tech job, right? There's a lot of competition there. Be a blue collar worker, go get a trade skill like electrician, plumber, HVAC. Those people are exploding with growth right now because people are not wanting to do it themselves. Those blue collar jobs are exploding. Learn that trade. Or number two, learn sales, because if you're making company money, you're never going to be fired as a salesperson.
That's right.
So we at one of the companies I control, we do a lot of commercial advertising, OTT, which is over the top television on connected TVs. Pre-pandemic, smart television levels in the American households was right around 20%, maybe a little bit less than 20% pre-pandemic, meaning all of the smart TVs with the Roku's built in that are streaming all of the smart channels. Now, where we're at, we've exceeded 80% of American households have a connected television inside of them. So what happened? Everybody received their money from the government for the pandemic, and they were probably shopping for toilet paper at Costco, and somebody said, honey, look at that beautiful 65-inch ultra-high-def television for $500. Let's bring it home too.
So I'll give you a pro tip here on if you really want to know where to take the next handout, which I believe may well come. My recommendation would be either buy food they can store semi-long term, because if nothing else, it's not like you're storing it because of an apocalypse. You're just storing it because the cost of food is going to keep going up. So you're giving yourself a discount by buying now, storing it, and whatever.
Hedging against inflation.
Yeah. And then the other option that I think is wise is to buy as much silver as you can stand that's physically in your house, because the ratio of silver to gold right now is about 75. That means 75 silver coins, 1 gold coin. The historical ratio of silver to gold is about 20 to 30. So that means you're getting a heck of a discount on silver. So what you're doing is you're taking your fiat check and you're trading it for a hard tangible asset. And it's amazing how many people think silver and gold have no value because they're being told that it doesn't have any value. It's insane. But that would be my recommendation. You do what you want, but that's just, for the next one that comes in, I've done it before and I will do it again. Thank you very much. I'll be setting this aside and hedging it against all this other crap you're going to throw at me. So
Mr. Kirk, break it down.
Yeah, we're wondering, are we heading for a recession? So this chart's going to show you that, again, that vertical dark blue bar is a recession period. Going back to 1950 would be the first bar on the left, all the way up to 2020, which was the pandemic. So you can see the white line is unemployment rates. Unemployment rates generally go up significantly at the beginning of a recession and throughout a recession, then start to drop. So with all these unemployment numbers that we're getting and all these companies that are laying people off, I think it's just the next linchpin to show that we are definitely heading into that recession period here shortly. I love what Nick
that's a hell of a spike, Kirk. And
20?
Yeah.
That's the pandemic.
Yeah.
Yeah, there's your pandemic right there. So, and you can see, it's the business cycle. Things go up, things go down. But the important thing is to, again, sharpen your skills. I love when things slow down in my business. I'm not afraid at all of the mortgage industry right now. It gives me an opportunity to build better relationships, to improve my systems, to improve my skills. And that's what I do when things slow down. I look for better partnerships. I reevaluate my entire business from top to bottom. And I look for new people to work with that are energetic and positive and want to convey and sell. To your point, Nick, becoming a better salesperson in this market, if you're in real estate, is the key to succeeding and surviving.
Kirk, can I come work with you? That sounds awesome.
Let's do it.
What a healthy work environment. That's great. Good deal. Hey, guys, I've got a question for you. So Jerome Powell, I pulled a clip. There was one of the gentlemen from Bankrate that was asking Jerome Powell some questions about the housing market. And I was listening, and I want to ask your opinion. Did Jerome Powell just publicly tell everybody to don't buy a house? I mean, this might be interesting here. I mean, watch this. Everybody, I want your opinion. Did he just tell us not to buy a house? And he specifically told millennials, you need a reset. So here we go.
Chairman Mark Hamrick with Bankrate. Wonder what your assessment is about the outlook for the housing market, given the years-long increase in home prices and now the sharp rise in mortgage rates. And all that, of course, given the heightened sensitivity around the housing market, given the fact that it was a trigger for the great financial crisis over a decade ago. Thank you.
Sure. So rates were very low. A good place to start is that rates were very, very low for quite a while because of the pandemic and the need to do everything we could to support the economy when unemployment was 14% and the true unemployment rate was well higher than that. So, and that was rates are low, and now they're coming back up to more normal or above levels. So in the meantime, while rates were low and while demand was really high, obviously demand for housing changed from wanting to live in urban areas to some extent to living in single family homes in the suburbs, famously. And so the demand was just suddenly much higher and low. So we saw prices moving up very, very strongly for the last couple of years. So that changes now, and rates have moved up. We're well aware that mortgage rates have moved up a lot, and you're seeing a changing housing market. We're watching it to see what will happen. How much will it really affect residential investment? Not really sure. How much will it affect housing prices? Not really sure. Obviously we're watching that quite carefully. You would think over time. So there's a tremendous amount of supply in the housing market of unfinished homes, and as those come online, whereas the supply of finished homes, the inventory of finished homes that are for sale is incredibly low, historically low. So that it's still a very tight market. So prices may keep going up for a while, even in a world where rates are up. So it's a complicated situation. We watch it very carefully. I would say if you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and demand are back together, and where inflation is down low again, and mortgage rates are low again. So this will be a process whereby we do our work in a way where the housing market settles in a new place and housing availability and credit availability are at appropriate levels.
Moment of silence for all of the young Americans, because Jerome Powell says you need a reset. Okay, I feel
everybody look at this pen and don't blink.
Yeah,
ready?
Yeah.
Pew! Reset.
I feel okay. So everybody hears things differently when we talk about things, right? Ever since the beginning of time, if we tell somebody here's a red apple, pass it to your friend and tell the person to the left of you that's a red apple, it might turn into green. Okay, but here's Sarge's takeaway from that. Young people, you need a reset. We just made some changes, not sure what it's going to do, but we're watching very carefully. Well, we've got an inventory and supply issue. We need to get things down to the norms. But we've got a lot of unfinished homes that are going to be coming to the market. We're going to watch everything carefully, but everybody needs a reset. And yeah, this might. There's a lot of loaded breath going on there. Moment of silence.
You know, when you're playing poker, Sarge, I think you're familiar. People start to get fidgety and they start touching their face and their ears. What does that usually mean?
Yeah, it's quite
There's
interesting.
a lot of face touching in that on that podium.
Okay. Big question from Mr. Jerome's speech for everybody. Yes, 12 to 18 months ago, in the housing market, when everybody was talking about supply issues, new home builders said, we're here. We'll take on the charge. And everybody all across the U.S., major metropolitan marketplaces, they started building, especially in major areas where people are migrating to, the Great Migration, a lot of the Florida markets. There's new construction going on everywhere. It takes time for that supply to go ahead and get caught up to the marketplace, right? But still, a lot of these phases of development are funded. All right, now we're starting to see builders going, all right, we have to put an escalation clause in here. We already have talked about that multiple times. People that are locked into contracts right now don't really know, and it's not a good contract. You could be paying $300,000 more in the next 9 months. But now all of a sudden, these mortgage rates that people have available to them and these larger loan levels just because of inflation, I kind of feel like there's going to be a lot of inventory empty, Mr. Kirk, when this comes around. What say you?
Yeah, the real estate markets are really driven by first-time home buyers, move-up buyers, and retirees. So right now we have a very low level of first-time home buyer available entry units. So if people aren't buying to get into the market because they don't have down payment, because they don't have the income, for millennials in particular, in my business, I see the income is not so much of an issue. It's more of a down payment issue. A lot of these people are making good money in stable jobs. But now if you can't sell your home to an entry-level person, you can't move up to the next one. And if a senior can't sell their home and know where to go and afford it, they're going to stay and age in place, which is what we're seeing. And Tim, I'm sure you could talk to this too. Even in insurance contracts, they're putting in clauses to help people pay for future healthcare needs, right, through your insurance policies. So it's just stagnated everything. I heard it a little bit differently. I heard Jerome Powell say, the reset is a reset in expectations, not a reset in being able to buy a house, just what that might look like. As I mentioned earlier, a lot of people went on a spending spree lately to buy investment properties on Airbnbs. That always has been a concern to me, especially in these smaller markets where if vacations stop, that industry is going to collapse for some period of time. So I think people just have to reset their expectations and start saving more and be willing to use alternative mortgage types. Like I said, ARM loans are going to be at 5%, if 30-year fixed is at 6.5%. So the affordability doesn't have to be out of control. It just means we have to have a few step process. You have to have a plan and some good advisors around you.
So what I'm hearing from what Kirk just said might be a competitive advantage for all the agents and brokers listening to buyers that are in the market and can't find a property. What if you started contacting Airbnbs and asking if they'd like to sell their property?
Yeah.
Wait, don't do that, Nick. It might be cheaper to rent the Airbnb than actually renting anything else, and I could just bounce around to different Airbnbs.
Well, it's kind of like, if you want to buy an investment property, one of the tactics to buy an investment properties is to call other investment properties that are for rent as a renter and say, hey, I like this place. Would you sell it? Yeah. Like, that's a prospecting method. So in this market where there's still tight inventory, if Airbnbs are going to be squeezed, which that could very well happen, you're going to have a whole bunch of people holding the bag on a lot of properties. And you might say that, oh, well, I only need to rent it 10 days out of the month to be cash flow, equal or whatever. 10 days can come and go really quickly.
Mm-hmm. Right? Folks that are watching the show right now, quick question for you, post in the comments. Did that answer by Jerome Powell give you any confidence? Yes or no? And that's the question for you, Paul, North Carolina Realtor extraordinaire. We love you. What do you have confidence after hearing that?
I think that we just need to keep our nose to the grindstone, and the real
Wait, don't avoid it. Don't avoid it.
Well, here's the thing.
Do you feel more confident or less confident after watching that?
I feel more confident because I'm determined to help my clients.
Good.
Yeah, as an agent. And what's the number one thing a real estate agent needs to do is listen. Listen to the motivation of the client. Are they motivated, and what are they doing? And is it helping them or hindering them? Because they may hear this from Mr. Powell and they're like, oh man, I'm scared to buy. I might just wait. But do you need to move? If you have to move, let's get you into a place, because things do, miracles happen. You get people homes are still selling. They're not going to stop. So
that was a great answer, Tim. I mean, seriously, that was a wonderful answer. Like political.
It was nice. I like it.
It was good. I like that answer.
I'll be honest. Like if I was, if I needed like a pick me up or like just someone on each shoulder, it would be Paul and Kirk to just sit there and like make me feel good about things. And you know, you got to have those people in your life.
Nick, you and I are totally left out on that.
Yeah. Well, and I'm over here with a different analogy in my head, and I'm like, he is the metaphorical boat captain. You're walking up to the boat. You're like, is this thing even seaworthy? Oh, it's fine. I mean, we think it's fine. No, you get on. We'll find out. And then you get on, and you're out there. You realize this guy is like 3 sheets to the wind. He's holding the freaking plug to the boat in his hand, tossing it up in the air. Might have dropped it overboard. We don't know. And yet you're asked to have confidence in his response of, no, it's seaworthy. It's totally fine. We have no idea how far we're going to go, and we don't know really if we're going to come back. But you need to set your expectations that we might, and that you can rest on. Like, that's the kind of crap I hear in my head when I'm hearing this guy speak. I'm like, am I the only one? Anyway. So
Tim, I agree with that, Tim. I don't ever feel comfortable when I see Jerome Powell speak. And
yeah,
he got on the stage. I've always been, what is this guy talking about? But I do trust history. And if you look at the charts and you understand how history has played out over and over and over, no matter who's sitting in Jerome Powell's chair, I believe in that. So, you know, here's what happens during mortgage rates during recessions. You can see mortgage rates have actually been coming down consistently since 1980. And here we are at 2022 down, 2020 down at 2.75%. Really, if you look at the chart between 1990 and 2002, it was kind of a flat interest rate market, and then it heading down a little bit. And then from 2002 to 2010, same thing, flat and then headed down. So I would expect we're going to see interest rates kind of settle in. It's a pendulum. Right now, they might go to 7% while the Fed is adjusting inflation and dealing with their problems. But I think it's going to settle in probably closer to 4.75 at the end of the day. Because look, at some point, the one of the things the federal funds rate does do is it impacts the cost of the U.S. government to pay for their debt. So if the federal funds rate goes too high, the government's not going to be able to afford to pay their debt. We see GDP predictions at 0 for this quarter, and they were at like 1.2% for the last quarter. So if GDP is not growing and we're not producing and the interest rates are going up, the government's not going to be able to afford it. I don't think they're going to let that happen. I don't know what it will look like, but I think they're going to have to find.
I think Jerome Powell serves another role, and that is, while the Fed is tightening screws here and there, trying to tweak this thing to keep it on the rails, his job is to go out there and basically instill, doubt and fear and uncertainty, right? So that by doing that, people will tamper their own desires to buy into the economy or to basically try and bring it down from an emotional point of view, not just the dials on the Fed, so to speak. So that's what I believe.
It's all based off of confidence. If they lose consumer confidence, then what?
We are in uncertain times. Like Kirk, I'm with you. Like history has a way of rhyming, but it's not a guarantee. And so I come back to, if we're looking at the historical charts of one isolated point or data point, and we go, well, based on this is what we should expect. And then I keep coming back with, yeah, but you've got all these other data points that weren't there when this was happening. Okay. And maybe it's 1 or 2 were there, but now we got all these other things. And we're talking about even global strife as well. And not to mention like the confidence that we have in the leader in that big house in DC. I mean, just there are anomalies associated with this thing that are just so freaking wacky that I'm like, you can't discount them. You just can't. And so anyway.
All right, let's go ahead and fly into our final segment. The reason I say fly is because I've got an awesome little clip for you guys. We're going to fly into our final segment. Everybody's going to come back. We're going to watch one report on a situation going on in San Francisco. Family went ahead and put their house up for sale. Nice home, nice neighborhood. 0 offers, 30 days. And then we're going to go ahead and ask every one of these fine gentlemen what their predictions are for the rest of the housing market in 2022. So let's go ahead and fly into our final segment. Tim, when are we going to do that? Tim, you want to do that with me?
Literally my worst nightmare.
I don't think I'm
okay, Nick, you're going for it. Yeah. We're doing this. So, all right, let's take a look at this report from the East Bay area, San Francisco. This is what's going on. This was yesterday.
Good evening. I'm Elizabeth Cook.
And I'm Ryan Yamamoto. We start with the cost to borrow money just getting even more expensive.
The Federal Reserve announcing its biggest interest rate hike in years, going up by 0.75 percentage point.
That means rising mortgage rates. The average rate on the popular 30-year fixed mortgage surged to more than 6%, up from 5.5% just a week ago.
And new at 6, KPIX5's Andrea Borba reports the rising costs could be creating a shift in the housing market.
For anyone used to the Bay Area housing market being white hot, the idea of a buyer's market is unfathomable. But with interest rates rising and more homes coming online, a cool down might be underway. Meet Ian and Lauren Finn and their kids, 5-year-old Jack and 2-year-old Evelyn.
This is my favorite toy.
They're ready to sell their 1,500 square foot, 3-bedroom, 3-bath home on Falling Star Drive in Martinez and move somewhere bigger with more room for little feet to run.
My room.
But there's a slight problem. No buyers.
We were told that there'd be tons of bidders, it would be very competitive, and we would immediately sell.
We launch on May 9th and nothing. Chirping, crickets.
Not a single offer since the listing hit the MLS.
We didn't get any bids, so then we lowered the price by $20,000, and again, no one has put in any offers, and we had to lower the price for a second time.
The East Bay housing report came out today. There are 1,900 homes for sale in the East Bay today, up from less than 500 in December. Combine that with rising interest rates, spiking gas prices, inflation, and a stock market drop.
Buyers are just hesitant. It's how do you pull money out if you just lost it all? Like how do you get a loan if the rates keep going up? You qualify for less.
After a year and a half of real estate insanity, Jennifer Hutt of Keller Williams, Ian and Lauren's agent, says there are still some hot real estate microclimates, like Marin County, where the median price just hit $2 million. But things are changing.
It's a resetting back to what normal used to be.
You see Bear behind you?
For Ian and Lauren, the concern is real.
Our whole goal was to get our house sold, get a new house, and move in before school starts. Every week that goes by, that possibility is looking less and less likely.
Lauren hopes they can sell, and this isn't foreshadowing something worse.
I do remember the 2007, 2008 housing crisis, and I'm a little, watching things and just hoping history doesn't repeat itself.
In Contra Costa County, Andrea Borba, KPIX5.
Okay. So that's hot off the press. That's happening. Predictions and actionable items for our audience. So what's going to happen in the rest of 2022, and what are some actionable items that we can give all of our viewers that they should be thinking about if they're selling their home, thinking about buying, or if they're a real estate professional that's representing? Nick, let's start with you.
Well, I think those people, the real estate agent didn't tell that family that their house probably is going to sell because it's falling down a cliff. I mean, we don't see that kind of stuff in Florida. Anyway, I think that the housing market is going to come to a halt by the end of the year. And I think that by next year, we're going to see interest rates, and maybe by the end of this year, I think everything's going to come to a screaming halt, and we're going to see interest rates go down again. Whether that is just a temporary bump, I don't know what goes beyond that. That could be the calm before the storm, the real storm. But I do think we are in an area right now where things are just going to get super tight, and then they're going to have to loosen it up again in the next 8 to 12 months, right? To spur on buying again, at least in the housing market. If I'm an active real estate agent, it's good to be as transparent and upfront with people as possible. And I know that's hard to do when you need a paycheck, but please don't take listings like they just said in that example that their real estate agent told them there's going to be multiple bids and the house is going to go quickly. Please don't let those words come out of your mouth, because it's not, the market is not what it was a week ago. Definitely isn't what it was a month ago. So make sure you are setting clear, very clear expectations with people, because we are going to be on the front lines in the next 6 months of price reduction conversations or just uneasy conversations with sellers who are still thinking it was 90 days ago when they're selling their house right now.
Good deal. Thank you, Mr. Nick. Tim Parnell, what are your predictions for the housing market for the rest of 2022? What are some advice items that you can give to real estate professionals, buyers, and sellers? Take it away for us.
Yeah. I can quote myself having said about a year and a half ago that I don't know if I can I said this to my wife as a real estate professional, said, I don't know if I can in good conscience, recommend that somebody buy a house in this market right now, given how much it was going up in value year over year, and sometimes every 6 weeks. It was just insane. But what I learned quickly was if someone wants it bad enough, they'll find a way, right? So then it was just my job. Well, if you want it, then let me help you get it. And that's my professional duty. But I would also give a cautionary tale of saying, hey, just so you know, things are not normal. This isn't the way it's supposed to be. You're on battlefield freaking real estate right now. And I guarantee your parents, if you're a millennial, have no freaking clue what you're going through buying a house right now. So as a real estate professional, I think you have a duty to inform appropriately that these things, not only were they not normal for the last couple of years, but where we're headed now certainly is going to be a different feeling. But I also think you're dealing with PTSD. And that is, you just heard that lady comment, I remember 2008, I remember 2009. And so that PTSD factor, people are going to, that is going to pump brakes on people that would normally be a buyer in this market or whatever, simply because they remember. It wasn't that long ago. If you're in your 40s, I mean, you are a part of that deal or older. And so that's my opinion of what I think is going to happen emotionally for people. And that will serve those people's emotions, the buyer's emotions will absolutely drive the market conditions. So I do believe, and for so many other factors, that we will absolutely see something that pulls back hard on the market, at least for a period of time. But I think there's going to be a lot of other factors happening that are not even predictable at this point. I really believe that is going to affect whether people want to even think about buying or just going to hold out or move in with parents. And I think you're going to have a lot of people moving in together, friends, family, just to split bills and survive. That's what I think.
Great positive outlook, Tim. Okay.
I'm here for that. I've got in my screen, I've got Paul and Kirk, I'm just glad to have them here to kind of smooth me over.
Wait a second. People are moving in with me.
Oh, yeah, I'm coming, buddy. I'm coming.
That's all I heard. All right, Tim, come on.
Part of my investment plan.
Oh my God. All right, Mr. Paul, North Carolina Realtor, take it away for us. Your predictions on the rest of 2022 and advice you can give to buyers, sellers, and real estate professionals.
Absolutely. So my predictions is that we will have a slight increase of inventory due to the interest rates and people overpricing their homes. And my preparation is that if you're a listing agent, list the home at market value. Not what Zillow says, not what you think you can get for the property, at market value. Because if you're going to list what you think you can get, which may be 15, 20,000 over, at this point, it's starting to sit. How do I say that? We have, as of today, 1,793 homes actively on the market. We just heard that the Bay had 1,900 homes on the market in California. Today, we've closed 24 homes. We have 67 pending. 15 decreased their price over listing. And we got 80 NL, guys. Hold on.
Sounds good. So obviously inventory is starting to increase in a lot of different areas, right?
Yeah, forgive me. That was new listings. I did abbreviations today, and I'm not good at that. 80 new listings today, guys. So we've got 80 on the market.
Sounds good. So what kind of advice do you have, Paul, for people that are buying, selling, or real estate professionals?
I think you should contact at least interview 3 real estate agents and see what they tell you and have them show you the backups. In other words, show me the comps, why I should list or why I should buy at this price.
Good deal. Mr. Kirk, break it down for us. What are your predictions for 2022? What do you have to go ahead and tell buyers, sellers? And if I'm an actual real estate professional, please share and spread your wisdom on me. What in the hell should I be doing?
You got it.
All right.
I see interest rates on 30-year mortgages at 7% by the end of the year before they start to recede back down in 2023 and beyond. I think this year, 2022, we'll see appreciation numbers year over year around 10%. Going into 2023, though, I expect that to flatten down to 0 to 5% going forward. If you're a real estate agent in this market, you have to throw out everything you think is real, meaning we are no longer in a real estate market of the last 5 to 7 years. It's shifted. So I agree with Paul completely. Price houses appropriately. Work on setting those expectations with the buyers and the sellers so that you can get homes sold. If you're taking listings today at high numbers because that's what's been happening, you're probably going to waste a lot of time and money and energy, and you're not going to get that house sold. You're going to end up listening to somebody else. Consumers right now are going to go through a process. They've been on this huge run up for the last several years where everything is great all the time and everyone's making tons of money. They're going to be hesitant to accept the reality of what's going on now. So we have to help them get to that reality faster because they're going to lose money too. People that hold out for high prices today are going to chase this market all the way down to wherever its bottom ends up being. And, I just said 10% appreciation year over year. Maybe next year we get 0% appreciation, but that's going to feel like a 10% reduction in values because it's just not going up the way it was. So people have to get realistic about that.
Interesting. Good deal. Should I put my opinion in here?
Please.
Oh, all right.
Make yourself the main person too. Come on.
Are you sure? All right. Ladies and gentlemen, my personal opinion is things are going to get rough and more rough and more rough. And I think it's important that each and every single one of you in your individual household start to take proactive measures, multiple streams of income, really take a look at your budget. All right. So that's important right now. And any times in the history of our country when we've had issues of wartime, economic pressures, downtime, recessions, it's the people that get going that win. Double up, work hard, really minimize the amount of bleeding that you have as far as financial outflow inside of your household. If you have any debt, shift it off those credit cards. So that's my advice. Now, here's what I think is going to happen with the housing market. Interest rates are obviously going to continue to increase because we have to go ahead and curb inflation. Although not just the Fed curbing inflation, I think that our government and our political leaders need to go ahead and have some really hardcore focus on underlining issues that are causing inflation with our supplies, our products, our goods, and our economic underbelly. Okay. I don't think that that's going to happen at any expeditious rate. So interest rates are going to be going up. I think new home construction inventory is going to go ahead and hit the market. I think that the Fed is going to continue to sell its mortgage-backed securities, which then the banks have to go ahead and carry on their balance sheet. And I think that's going to throw a lot of things off, which is going to force prices down over time. However, there is a factor that's coming into this that I think most people aren't focused on. I think that buyers are just going to say, you know what? I'm hurting so bad now. I used to have a savings account that said this, but since inflation has been happening, now it's down here. And they're just going to go ahead and say, you know what? I don't want to buy anymore. And I'm not going to buy at that rate. And I'm not going to buy at that price. And I think we're going to see a dynamic shift, which is going to go ahead and force housing prices to start to decline across the United States of America towards the end of Q3 and entering into Q4. So that is my take on everything. If you are a buyer and have to buy because you need a home to live in, I would say now is the time to go ahead and think about doing it. I also do think that sellers are going to feel a top here. And they're going to go ahead and say, you know what? We've got to go ahead and sell if we're going to go ahead and get our money that we've just ridden up to the top of this mountain. So I think we're going to see a lot more inventory hitting the market right now, especially with the latest Fed increase. So then we'll see it. We'll start to see price reductions in different marketplaces because of more inventory and less people actually bidding on those things because the buying pool is less. So we've got a lot of economic pressures that are all contributing to this. So this is not just a housing market situation, ladies and gentlemen. This is an everything situation. So my advice to you, look inward towards yourself. Be the most dependable you could possibly be. All of the folks that are working with you in your household, all of your friends, your family, your contributors around you, start working with them. Get talking. Be open. Get to be participating in your local marketplace. We can do this as an American economy, so as a culture, as a society, but it's going to take each and every single one of us. And that is my advice. If you are a real estate professional, be honest. Make sure that people understand these different pressures that are coming. And if you're a seller, I think it's time right now to sell. I think if you wait, you're going to go ahead and have a little bit of a tough time coming into the later part of this year. And we do have a midterm election that we're all going to be dealing with. So we're going to have that kind of fun again, ladies and gentlemen. All of us, no matter who you vote for, we're going to see a whole bunch of election year type stuff towards November. So get ready for that. Do some stretching. But that is my opinion on the matter. And be prepared.
Sarge, I got a funny picture to share
based
on what you said earlier. What's the actual inflation versus official, what they're saying?
Yeah.
That's what 3% looks like, or what were you saying earlier? 10%?
8%?
Yeah.
8%. So good luck to all of the businesses that are out there. Anybody that's watching that's in the restaurant type industry and things like that. I know people are starting to pull back on their spending just because everybody's dealing with it. So good deal. Gentlemen, any final takeaways?
Oh, I think you wrapped it up nicely, Jake.
Okay. Good deal. All right. Well, thank you very much for contributing to the show, gentlemen. We'll go ahead and see the three of you fellas on next Tuesday. Thank you very much. We appreciate you guys. Nick, that was a lot to talk about.
Man. We went from a pretty happy show a couple months ago to try not to bring as much doom and gloom as possible, but sometimes the truth is what we need here, right?
Well, give me something cool to talk about.
Yeah, right. Exactly.
So news is changing week to week, and it's been changing that way. So
yeah,
good deal. All right, ladies and gentlemen, once again, we're streaming live on the RU Nation Network. We're live every Tuesday and Thursday at the strike of high noon. Okay, so if you haven't gone to runation.com yet, go check it out. runation.com. We've got the Real Estate America's newsroom over there where you can check out all the latest show clips and those kind of things. Enter your information to get all of our back show notes, all of the different articles, publications, and different news clips that we go ahead and bring to you guys on the main news. And if you want to be on the show or have some hot insider news, there is a block over there where you can enter your information, and we'll bring it up and discuss. Nick, should these people like and ring a bell for us?
Yeah, tickle that bell and share the show. If you got any value from what we're talking about, please share the show. We are doing this just for you guys, right? We are industry. We are in the real estate industry. We are just as concerned as you. And you know what? The general adage is, if you want to become an expert at something, you should teach it. So right now, this is what we're doing. We are trying to sharpen our skills and becoming even more experts than we currently are in the real estate space by absorbing as much information as possible, talking to as many people as possible, and making it a public forum so we can make everybody better.
Good deal. All right. Well, thank you, Mr. Nick. Have a blessed rest of your day, sir. We'll see you next week.
Thank you, sir.
Yep. All right, ladies and gentlemen, that was Real Estate America's Newsroom. If you liked what you saw and if you enjoyed the commentary from some of our other hosts, please share those comments, share the show. Let us know how we're doing, good or bad, because we want it all. Just give it to us. So once again, we're here every Tuesday, Thursday at high noon Eastern, 0900 Pacific. If you want to be on the show, let us know. And please do us a favor, hit the like button and share the show with everybody. Ladies and gentlemen, we're coming into a weekend. Be safe. We want to see you guys all next week with all your fingers and toes. And until next time, be blessed and unstoppable.